Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Wall Street on track here to end the week higher. That's after slumping most of the week amid new inflation data and fresh tariff threats. We're going to dig into those stories. And right now, there's just an hour to go until the closing bell, and stocks, they are higher here. Taking a look at the popular averages. The Dow is up about 360 points. The S&P 500, your broad gauge, is up about 0.6%. Tech-heavy NASDAQ is up about 0.4%. Let's welcome Fed correspondent Jennifer Schonberger. We've got senior markets reporter Nez Ferre and data and markets editor Jared Blickery. Jared, let's get to you first on the day's trading action so far.
Thank you, Josh. As you said, it's a bullish-looking day, kind of a mixed week here. We'll take a look at both time frames, but the Dow is up 0.8%, pretty close to the session highs, which we got to around the open. And let's check out real quickly the 5-day, because it is barely, almost break even right there. So we'll see if it can pull out a win into the close. Now the NASDAQ, while it's up 0.4% today, this is what happened this week, still down about 2/3%. That's not a lot, but that is the worst that we've seen since August 1st. So it's been several weeks of bullishness, and we aren't used to seeing these losses on a weekly basis. Same for the S&P 500, only down 0.3%. But let's switch this back to the intraday, and you can see we're pretty close to session highs here too. And we will check out the Russell 2000, which is up 0.8, pretty much on par with the Dow. Although the Russell, let's take a close look at the 5-day. That is underwater by about 0.75%. Also the worst week since August 1st. And here's the 10-year T-note yield. It's up a whopping 1 basis point today. But you can see the trend. It has kind of jumped up since Wednesday. So that's a trend that we'll be looking at. Nothing concerning right now. And the 30-year, that is also up 1 basis point today. U.S. dollar index down slightly, 0.4%, but up on the week. And these last 2 days, we saw some pretty big jumps there. So a little bit of relief there from the Dixie. And let's skip ahead to the sector action just a moment ago, and still everything is in the green. We got consumer discretionary in first place. That's up almost 1.5%. And guess what's in last? Consumer staples. And that's where you want to see the defensive. Now, tech is the second worst here, but still in positive territory, underperforming the S&P 500. But what's working well today, utilities, materials, real estate, healthcare, all of those up more than 1%. And if we dig into the NASDAQ 100, you can see a mixed picture with respect to the mega caps, but overall a lot more green than red. You can see Nvidia just barely negative, Apple too, but Tesla up 3.5%. Let's check in on the 5-day price action for Elon Musk's company. You can see adding about 3% percentage points worth of gain. Microsoft also in the green there. And let's just dig into the semiconductor space, because we're seeing more red than green here. Intel's a bright spot. That's been doing well for the last few weeks, up 20% over these last 5 days. But you take a look at software, it is a much more bullish picture. We're seeing ServiceNow up nearly 2%, IBM over that threshold, Take-Two over 4%, and the list goes on. So I think I'll leave us off on the Dow here. And aside from the mega caps, we're seeing some outperformance from JP Morgan up 1%, IBM, Big Blue up 2%, McDonald's, Salesforce each up 1%, and Boeing up 4% over this week, about 3.07%. Josh.
All right, Jared, thank you. Fed officials Barkin and Bowman weigh in on the inflation fight today as markets digested fresh PCE data. Jennifer, put it all in context for us.
Hey there, Josh. Happy Friday. A fresh reading on inflation shows prices remain sticky, but today's report unlikely to keep the Fed from further rate cuts later this year, especially if the job market remains soft. The Personal Consumption Expenditures Index on a core basis, which excludes those volatile food and energy prices, clocked in at 2.9% for the month of August, in line with expectations and holding the same level as July. So inflation may not be reversing, but it's not accelerating either. And Fed Chair Jay Powell said earlier this week that increases in tariffs will likely result in a one-time increase in prices. But that may not all be at one time. It may be spread over several quarters. And so it may feel like inflation is somewhat higher. But other members of the Federal Reserve are concerned about the risk that inflation could prove longer lasting. Chicago Fed President Austin Goolsbee said on Thursday, quote, "If we are in this environment where inflation's been above the 2% target for almost 5 years in a row now, and it's going the wrong way, just counting on the inflation to be transitory makes me uneasy." But Richmond Fed President Tom Barkin said earlier today that productivity increases from AI and automation from companies could offset inflationary pressure. And it may just be that the next jobs report will be the determining factor for what the Fed does next, assuming there's no government shutdown and we get that report on time. Here's Barkin.
What doesn't seem to debate to me is that you got to move a little bit toward the employment side of the mandate, given what we've learned over the last 3 months. And so that's how I see it. It's a little bit of a move. We'll get more information as the months go on, and we'll see whether you'd continue that or back off. I mean, there's a lot of different ways you could go, but I take each meeting as a time, and I think there are more risks to the labor market. It made sense to do something about it.
We also heard again from Fed Governor Michelle Bowman for the third time this week, who again expressed her concern about deterioration in the job market and that there is a serious risk, her words, that the Fed could be behind the curve, which could lead them to have to cut rates faster and in larger increments. Bowman saying that the Fed needs to act, quote, decisively and proactively. Josh?
All right, Jennifer, thank you. And also, Trump's latest tariff threats targeting pharmaceuticals and furniture with duties as high as 50%. The move is rattling furniture industry, raising fears of higher costs and fresh supply chain disruptions. Senior reporter Inez Frey joining us now. Inez.
Yeah, Josh, those tariffs on upholstered furniture, also on cabinets. So we've been watching shares of RH, also of Williams-Sonoma and Wayfair. Wayfair actually deals with vendors. So they have been already diversifying sort of outside of China. You have also RH and others that have been bringing manufacturing more towards North America. But this is certainly an industry that has been sort of hit over the last year or so, where you have the housing market that's been stagnant. You have consumer discretionary, that perhaps people aren't spending as much on their furniture as they did during the pandemic. But another corner of the market that has also been under pressure really has been the pharmaceutical space. And President Trump also announcing 100% tariffs on pharmaceuticals from that are coming from abroad. Now, we did see, though, shares of Eli Lilly, Pfizer, really a muted reaction. In fact, some of these companies actually going up, and that's because one of the exemption to those tariffs is unless you are manufacturing, you have some manufacturing facilities here in the U.S. by October 1st. Well, most of the pharma companies do have manufacturing here in the U.S., and you've had Mitsuho noting that the impact of these tariffs may be nebulous or negligible, basically, and that's why you've seen a muted reaction with these healthcare stocks. Now, it's unclear about what exactly will happen with respect to the EU, because you already have a framework, a pact that puts a cap of 15% on pharmaceuticals and some other products from the EU's. But certainly the biotech companies, the smaller ones, those may be more exposed to these tariffs, Josh.
All right, thank you, Inez. So what might these new tariff threats mean for inflation, growth, and the broader economy? Ian White, Huntington Commercial Bank Director of Economics, joining us in studio. Ian, always great to see you. Let's pick it up right there, Ian. So President Trump goes on social media calling out these new levies, pharmaceuticals and big trucks and furniture. As an economist, Ian, you saw that, and what'd you think?
I think it's really the impact we're going to see is going to vary industry by industry. If you go, for example, let's walk through them. Trucks. Trucks are largely made in the United States. It's a relatively small percent. I live in North Carolina, so a couple of these industries are very close to North Carolina. We have a Daimler truck plant on the outskirts of Charlotte. So a lot of that relatively muted impact. Furniture, much bigger impact because, as North Carolinians will tell you, where a lot of furniture was made, that largely has left. What's left is really the high end. So, the RHs of the world. There's still some of that made in the U.S., that custom stuff. But it's also something where there's a huge amount of labor that goes into that. And I'm really curious if even at those high tariff levels, if it'll make sense economically to manufacture in the U.S. And that's really the split we've heard from companies. Depends on the industry and the space. Is it that the whole supply chain's overseas and there's a lot of labor intensive stuff, and so even at pretty high tariff levels, they're just going to eat the tariffs? Or is it something where it really makes sense to bring manufacturing back, or you can automate it? In those cases, yeah, we're seeing a lot of stuff pulling back to the U.S. You saw it in Costco's earnings that highlighted that, pushing more of their sourcing to being domestic.
Why is Trump doing this? It's because he wants more stuff made here. As an economist, do you think of tariffs as an effective policy tool, Ian, to achieve that objective?
I would call it a blunt policy tool. It certainly has its costs you pay with it, but I mean, there is a reason to think you can achieve that objective to some degree. Where I'm a little hesitant to say, and I think I've talked to you about this before, but I had a similar conversation literally a couple of weeks ago in upstate New York with a big manufacturer there. I said, look, we're still struggling on the skilled worker side. We can't get enough workers here, and it's a conversation I've had over and over again with manufacturers. So the idea of bringing a ton of manufacturing back here is really challenged by the labor force side. We have just limitations in terms of the number of Americans who are willing to work, particularly in some sort of plant where it's hot, it's difficult working conditions. That's where you really start to struggle to get folks in here. And I think we still see a tight labor market at that lower end. You are seeing some job growth. A lot of it's leisure and hospitality right now. A lot of it's healthcare and social assistance. You pull that apart, a lot of that's actually social assistance. People are missing this story. And what is social assistance when you go even deeper? It's home health aides. It's 200,000 more home health aides we have this year than this time last year. So you have tremendous growth in some of those categories, and those, quite frankly, are really competing. Those Amazon warehouses, all those things are competing directly for those lower end manufacturing workers and pushing up the wages. So that always is the calculus, of course, is what's wages abroad, what's wages at home, and then, of course, what are the tariffs going to cost me?
What did you make of the PCE report today? No surprises there, but
No.
We do seem kind of sticky around this roughly 3% level.
Yeah, do we want to live with 3%? I think was what Goolsbee was kind of implicitly adding. And there was a good question, of course, to Powell the other day that's saying, hey, we've been 2 years away from getting to the 2% inflation target for many years. It's always, the country of tomorrow or whatever. We're the 2 years away from the inflation target. It seems like at this point, as Barkin mentioned, they're really focused on the employment side of the mandate. I expect, we'll probably get another 25-point cut in October. It certainly seems like the messaging is largely aligned there, except for maybe Powell. I expect December as well, and here's why, although I specifically asked Barkin about this, those deferred federal job cuts. That could be, if you read the numbers, potentially you're talking 150,000 federal jobs come off the payrolls in October. That gets printed early November. You have the December meeting may be coming off a jobs report that's really ugly, not too long, not too far previously. So, that's something Barkin says he's going to see through. He's going to try and ignore, much like Powell said, the one-time jump in tariffs. We will see. If I'm the Fed, I'm having a hard time not cutting if I'm seeing, maybe a negative 100,000 jobs report, even if we know that a lot of those are Doge cuts where people are maybe taking early retirement and not really pushing up the unemployment rate in a significant way.
I've had smart people sitting in that very chair, in your chair, who say they should stop trying to stick the landing on a 2% target. They should move to a range. That would make a lot more sense. What do you think?
I think at this point, if you change the inflation target when you aren't near target, when you haven't been achieving it, it more says that you're quitting. And if you listen to the Fed, if you listen to Muslim, for example, gave a good speech back in March on this, talking about it, it is inflation anchoring is a very core part of how they think about inflation, especially in a stagflationary scenario. And that, of course, is the nightmare scenario of any central bank. Now, right now, we're still growing. We're not in a stagflationary scenario, but maybe we're not that far from a stagflationary scenario, and that certainly is the Fed's nightmare scenario to deal with as a central bank. It puts you in a very difficult position, and they're worried they'll have to pull a Volcker and crash the economy to deal with inflation. And that is, no central bank governor wants to double unemployment. The human cost behind that is massive. The life expectancy cost, actually. People die quicker when you spike unemployment. It's not just an economic cost, it is a human cost that's pretty brutal. So I think the Fed doesn't want to unanchor expectations, and that keeps them from, changing the target. And so I think it's also, they do have two mandates. They do have the employment mandate. Sometimes the critics of the Fed say, hey, we should just cut. I mean, we should just keep rates high until inflation hits target. And they're treating it as if there's one target. And right now there's two. And one of them's just, 0.9% above target. That's not that far. They're pretty close, although it's kind of seems stuck there. The other one, we see really low labor turnover right now. We see, unemployment starting to rise in, say, the 18 to 24-year-old population, some of those more marginal populations of new workers. We have this kind of stagnant labor market where people are getting hired. So I think they're focusing on that piece, and I agree with that focus.
How did Powell put it? I think you said a challenging situation, Ian. Seems about right. Thank you, sir. Always great to see you. Coming up, the tech-heavy NASDAQ may be feeling some pain after a few down days on Wall Street. We're going to tell you what you need to know about big tech stocks. Plus, automaker Packard stock is getting an acceleration Friday. We'll explain why that is. And Boeing stock is taking off after some relief from federal regulators. We'll explain further what's behind those moves, those stories, and more. Coming up, stick with us. The tech-heavy NASDAQ cut off a third day of declines with big tech stocks taking hits, complicating calculus for interest rate cuts and warning flags over AI spending, casting a shadow over the sector. To dig into the shifting dynamics, let's welcome in now Baird tech strategist. That would be Ted Mortensen. Ted, always great to see you, especially on set. Let's talk about that great AI spending boom. There's a lot more headlines this week with that, Ted. And I think investors are asking, because the numbers that are thrown out are just historic, right? Many years from now, Ted, or maybe not so many years, will Ted and Josh be sitting here and we'll say, you know what, it all worked out. It all really did culminate, Ted, in material revenue growth. The ROI is going to blow investors away.
The answer is nobody knows. And I think that's
not so comforting, Ted.
No, nobody knows yet, because one common link to all this is OpenAI. And their loads are incredibly powerful, but you just don't know what that model looks like from a return on invested capital, if they can actually monetize a large language model. Now, Palantir, if you talk to Palantir, they're saying inference prices are dropping and the values in the software. So the spend is historic. I mean, if you look at the $400 billion that the cloud titans are spending this year, that's projected to be up another, call it, to 700 billion worldwide next year. Where there's a worry is two things. If you look at the cloud titans, their free cash flow last quarter was somewhat down materially. If you take Oracle, for example, their trailing 12-month free cash flow, negative 5.9 billion. So free cash flow is front and center with all of my clients, number one. Number two, we are going to be entering a major debt cycle. And right now, all the debt that's being accumulated, I think the assumption is it's priced to the dream scenario. Nobody knows if there's a hiccup coming here as we relate to roll out this massive infrastructure build.
There are skeptics. I want to run this by you.
Sure.
Thought of you when I saw this. Bloomberg with a piece donating hedge fund manager David Einhorn, smart, well-respected guy. He's kind of sounding a warning on this, Ted. He's throwing a red flag on all this capital pouring into AI infrastructure. Does expect AI will ultimately surpass today's bullish forecast, but question whether, quote, spending $1 trillion a year or $500 billion a year will deliver good outcomes for the firms making those investments. So if I see that, am I nervous if I'm an investor in an OpenAI or a Meta?
I think it's that tier 2 and 3 where you really have to concern the new companies coming out of Google and Amazon and Meta. Those startups, they have to have scale, and to have scale, you have to have not only brilliant engineers, number one, but you have to have the sales and marketing. And that's very, very hard in this cycle of Gen AI because it is really a large cap cycle. You need free cash flow. And the companies that are negative free cash flow, I would agree with them. A bunch are not going to make it. And from a VC perspective, you only need 1 in 20 to score. So I think they have a different model, to be quite honest with you.
Let me ask you, when you're thinking about, okay, I want to play this mega AI trade and theme, what, Ted, are the smart opportunities?
I think you have to really scrutinize how free cash flow is going to look. And right now, if you look at the stocks up 21, 22% versus the IGV software area, both can and will generate free cash flow. I think where there is an aha moment is some names that are going negative free cash flow for the sake of believing in that dream. That's where I think there's some avoidance.
Ted, I had 100 more questions for you, but we'll leave it there for now.
Okay, great.
Thank you, sir.
Thank you.
More in American cities, we'll get to see late night TV host Jimmy Kimmel, one of 2 TV station owners that dropped his show, is putting the program back on the air. Senior reporter Allie Canal joins us now with those details. Allie.
Hi, Josh. Yes, the ongoing saga here continues, but we did hear from major affiliate Sinclair Broadcasting announcing that it would resume airing the program beginning tonight, Friday night show, while fellow broadcaster Nexstar continued to refuse to carry it. Now, Nexstar's decision comes just about a month after it announced a $6 billion deal to acquire rival broadcaster Tenga. Now, this is a transaction that still needs regulatory approval from the FCC. That's part of the ongoing backlash here. But this also has just reignited a debate about where the future of broadcast stands at this point, especially as more consumers migrate over to streaming platforms. And this is something that Yahoo Finance reporter and anchor Julie Hyman spoke with Lightship Partners' Rich Greenfield about earlier today. Here's a bit more of what Rich had to say.
It's certainly within the rights of Sinclair and Nexstar not to air programming that they don't think fits with what their constituents in their markets want to see or believe they should see. That is fine. They have that right. But ultimately, that makes the long-term viability of shows like Kimmel or content like Kimmel harder to put on national television. The more you water down linear broadcast TV, I think ultimately that is not a good thing for these broadcast TV stations as you look out over the next 4 or 5 years.
And to that point, we have seen this massive change in viewing habits. We have this acceleration of cord cutting. Ad budgets are following the audiences to streaming platforms. And more you're hearing about younger viewers finding a lot of these late night clips on YouTube. So Greenfield arguing that these boycotts only reinforces those types of trends. And for Disney, Greenfield saying that it doesn't really make sense for them to hold on to these linear assets, that they should spin those assets off and focus instead on theatrical, on studios, on their parks business, that this doesn't really make sense within the context of what they're trying to do and move ahead in the future. We just saw that Disney raised prices for the 4th consecutive year across its various streaming platforms, this coming as they're really trying to reach sustained profitability in that direct-to-consumer division. So, Josh, just an interesting development here this week about how this decision about Jimmy Kimmel just sort of creating this ripple effect across the media landscape, across broadcasters, and certainly across Disney.
All right, big important story. Thank you, Allie. Appreciate it. Coming up, a Solana-focused cryptocurrency treasury company is expanding its business. More on that on the other side.
This morning, the Fed's favorite inflation gauge, PCE, ticked up to 2.7% year over year, still above the Fed's 2% inflation target, but not reheating. But I keep hearing the S word recently, and that's for stagflation, and that's what we're digging into on today's Stocks in Translation. First, let's get our terms straight. Stagflation here means 3 warning lights flashing at once: weak or negative growth, high unemployment, and high inflation. Stagnation plus inflation. And some folks draw a line between capital S, the 1970s kind of stagflation, and the lowercase s when only parts show up. And since the pandemic, we've really only seen the lowercase kind. So let's break down the 3 major components right now. Starting with economic growth, we have GDP, or gross domestic product. It's the home field scoreboard. It's what's made inside our borders, and gross national product, or GNP, tracks what Americans earn anywhere on the planet. You also have gross national income, GNI. It rolls up wages, profits, and taxes, less subsidies. And fun fact, economists often watch GNI when profits or labor income look out of step with GDP, like right now. Then there's inflation. You've probably heard of the Consumer Price Index, or CPI, which is a household shopping basket. There's also personal consumption expenditures, or PCE, which is a broader base instrument, and it adjusts for substitution, and that's why the Federal Reserve likes to use it. And we should also distinguish between so-called headline inflation from what's called core. Headline includes food and energy, while core strips these volatiles out to see the trend. And today's read was 2.7% headline and 2.9% core, much cooler than 1970s, but warmer than the Fed's 2% target. And for jobs, we watch the unemployment rate and how many payrolls are added or subtracted each month, courtesy the Bureau of Labor Statistics. We also like to watch the weekly filers for unemployment claims since it's higher frequency. If claims start climbing while payrolls fade, that's part of the stagflation case gathering clouds. Now, let's check the history. Here in this table, we can see that in 1975 and 1980, we had a capital S. Unemployment north of 7 or 8%, double-digit inflation, and contracting output as GDP plummeted. We didn't really have anything close to that until the pandemic in 2020, but there is a key difference. In the early days of COVID, unemployment spiked and GDP fell off a cliff, as we remember, but prices didn't rise yet. Price inflation actually dropped to nearly zero in 2020, which is almost deflation. So it was stag without inflation. But by 2022, all the stimmies finally started jacking prices higher, north of 9%. The economy shrunk modestly, but joblessness stayed low. That's only 2 out of 3. And today, unemployment is modest, PCE is in the high 2s, and GDP is fairly strong. Definitely not 1970s territory. And we'd be remiss if we didn't point out some market stats. It can be tricky to trade stagflation, and as I just said, that's really not even the case today anyway, but one thing's for sure, precious metals are soaring. Gold is up 40+% this year, and silver is approaching 60%. Metals love elevated inflation when the Fed is cutting interest rates like right now. So here's what we want to watch for in the S checklist. On the data front, we're going to continue to watch jobs and CPI and PCE and GDP. We're especially keeping an eye on services inflation, as well as shelter, insurance, and healthcare costs. If these cool down, then core inflation cools as well. Then watch energy and the dollar. An oil pop or weaker dollar can reheat headline inflation pretty fast. And finally, this is a little tricky, but we want to monitor real incomes versus demand, which means workers' paychecks after inflation and to make sure that they're growing faster than spending. Are people starting to dip into their savings and rack up their credit cards? That's a yellow flag. Bottom line, right now, there is at least a chance of lowercase stagflation risk, but it's unlikely to get anything like what we saw in the 1970s or 80s based on what we're seeing right now. But if all three lights turn green, growth, jobs, and prices, well, guess what? That is your stagflation siren. And tune into more episodes of Stocks in Translation on the Yahoo Finance's website. We have new episodes dropping every Tuesday and Thursday.
Digital asset treasuries are gaining traction on Wall Street. These treasuries are public companies that, instead of mainly holding cash on their balance sheets, buy and hold digital assets, like Bitcoin, giving investors indirect exposure. So far, more than 180 public companies have added Bitcoin to their balance sheets, many just in the past year. It's according to BitcoinTreasuries.net. Now, a new player is entering the space, but this time the bet isn't on Bitcoin, it's on Solana. Sports business firm Brera Holdings is rebranding as Soulmate, shifting to a Solana-based digital asset treasury and crypto infrastructure platform. And join me now, we have Marco Santori, Soulmate founder and CEO. Marco, it is great to see you. So let's start big picture, Marco, because just walk us through this theme of digital asset treasuries, Marco, where there seems to be this explosion, a real kind of gold rush going on. What explains that trend?
Yeah, thanks for having me. And you're absolutely right. There really is an explosion going on right now. But I think I'd change the metaphor. I'd say what you're witnessing is the uncoiling of a spring that's been held tight by 4 years of bad policy in the U.S. And frankly, an economy who just wasn't ready for it. And today we have something new. We're seeing that spring uncoil, and we're seeing a whole rush of treasury companies that frankly should have been founded years ago right? And probably should have been founded from the very beginning. Now we're seeing those be founded all at once today, and we're seeing a gold rush-like mentality appear. But really, what we're seeing is temporary. What we're seeing is transitory. And what we'll start seeing as time goes on is a slowing of that, slowing to a more, whereas this is more of a gold rush cadence, we're going to see more of a venture capital like cadence where good new projects come along occasionally and not just, a dozen a week like what we've seen over the last few months.
If you looked ahead, Marco, would you suspect, okay, in this space there's going to be many winners, Marco, or no, it'll be a few? And what are the sort of variables that will decide that, do you think?
Yeah, it's a good question, right? If there's so many of these things existing now, well, how many of them can really exist? And I think the answer is straightforward. There will be as many treasury companies as there are differentiated and durable treasury strategies. So you're not going to see 10 years from now, right? 5 years from now, or even maybe 1 year from now. You're not going to see so many treasury companies that are copycats of each other, that are trying the very same strategy to accumulate coins. So let's back up and think about, why does a treasury company exist in the first place? Well, we'll use Soulmate as an example. Soulmate's North Star is Solana per share, Sol per share specifically. Soulmate's not trying to get real big. It's not trying to go real fast. What we're trying to do is make Soulmate stock a better investment for you if you believe in Sol than just buying Sol on its own. Because when you buy Soulmate stock, you're also paying for a management team that is out there trying to accumulate more and more on your behalf full-time in a highly inefficient market, which is what the crypto market is today. So you can go off and you can buy Sol on your own, and you can hold that Sol, you can stake it, you can try not to lose it, you can participate in DeFi, and that'll make you more Sol over time, but we think we can do it better and without any of the hassle.
Why, Marco, bet on Solana specifically? Why Solana rather than Bitcoin or Ethereum?
Yeah, well, to be fair, I am personally a Bitcoin believer. I think Bitcoin is special. It is a new monetary system. It is a generational and maybe even more rare occurrence in the course of human affairs. Ethereum, which is another example you gave, was an attempt to broaden that model to more than just money, to make composable smart contracts that were tough to interfere with and were reliable and composable, that you could kind of treat like Legos. You could build business logic on top of business logic that involved finance and money. The problem with that is that it just didn't scale, and it hasn't scaled, given years and years to scale. Solana does scale, and when I say scale, I mean where Ethereum can only do a handful of transactions per second, Solana is geared up to do hundreds of thousands of transactions per second. You can actually run a new financial system on Solana at the base layer without too many bells and whistles and complexities that you would need to build on top of Ethereum in order to run that. So when I think what system, what protocol, what blockchain is a new financial system going to run on if we wanted to build one, I'm not thinking Ethereum, I'm thinking Solana.
Marco, what do you say to those critics? I'm curious to get your take of digital asset treasuries. I'm thinking of guys like Jim Chanos. You saw his comments, Marco. We seem to write it off as, this is just marketing. This is just financial engineering. What's your response to that?
I gotta say, I kind of agree. I think a lot of these treasury companies are relying solely on financial engineering, when in reality, what they're trying to build is a fantasy, right? It's a perpetual motion machine. I think without an underlying business to keep that momentum going, to spark more momentum when the flywheel slows down, a lot of these treasury companies are trying to build something that just defies the most fundamental laws of financial physics. Soulmate is different. Soulmate is building actual infrastructure right here in the UAE. You can see I'm not in studio. I'm in the Emirates. We're building actual financial infrastructure, hardware, bare metal servers that we're standing up here in the UAE to help process transactions on Solana. And as a result, we hope to do much better on revenue, both in bull markets and in bear markets, than the competition. And that's going to allow us, like I said, to add momentum to the flywheel and to kickstart that flywheel if ever momentum really does grind to a halt in a bear market. I think that sets us apart from other treasury companies. And I think that's one of those durably differentiated strategies that sets us apart from folks who are just doing the financial engineering, like ATM sales and bond sales and convertible preferred sales. We're actually building a company here.
Marco, it is a fascinating conversation. Thanks so much for your time today. Appreciate it.
Thanks for having me.
Now time for some of today's trending tickers, starting with Packer. Those shares rising as President Trump is set to impose a 25% tariff on imported heavy trucks. The new duty to take effect on October 1st. Packer is being viewed as one of the beneficiaries of Trump's tariffs. It's the parent company of Kenworth and Peterbilt trucks. And turning to Boeing, that stock is jumping. The Federal Aviation Administration giving the jet maker the green light to sign off on some of its 737 MAX and 787 Dreamliner planes before they're handed over to customers. This coming after years of tighter restrictions after fatal crashes. And finally, shares of EA spiking late in the session. The Wall Street Journal is reporting the deal would be valued at roughly $50 billion, making it one of the largest leveraged buyouts ever. The Journal says the group of investors includes Silver Lake, Jared Kushner's investment fund, and Affinity Partners, and the Saudi Public Investment Fund. Well, coming up, we're digesting the global market value of the weight loss drug industry. More market domination when we return. International equities have outperformed U.S. stocks year to date, but analysts are suggesting that trend could shift going forward. Yahoo Finance's Allie Canal breaks down whether the Sell America trade could become the Buy America trade in the Yahoo Finance Investor Playbook.
Earlier this year, talk of a Sell America trade spread across Wall Street. We saw U.S. stocks, treasuries, and even the dollar all tumbling at once. That's an unusual move that shook confidence in America's safe haven status. But just a few months later, that story has now flipped. Foreign investors are sticking with U.S. stocks. The dollar, although still weaker, has stabilized, and Team USA seems to be back on top. That's all thanks to fading tariff fears, easier Fed policy, and a still strong U.S. economy. Strategists tell Yahoo Finance the swings show how quickly sentiment can turn. For example, panic over tariffs faded as companies managed the impact better than feared. That was aided by carve-outs, cost absorption, and rerouting shipments through lower tariff countries. According to Citi, the effective U.S. tariff rate is now closer to 9%. That's about half of the 18% theoretical rate, showing just how much those carve-outs and workarounds have helped blunt the blow. Meanwhile, the Fed's pivot to easing, lower interest rates, renewed confidence in U.S. growth, that's all helped restore investor optimism. Here's a little bit more of what strategists told us this week.
It went too far. That is one area where we think that delta between U.S. and international just kind of was too large. At its peak, the difference between the two was about 17%, meaning the international stocks were outperforming U.S. stocks by 17%. So we took the bet that was going to collapse. And that trade has been working out. International stocks are still outperforming on an absolute basis, but since April, you've seen that collapse to about 10%, the difference between the two. So we think that's probably going to continue.
But overall, I think our main thesis is global diversification is really key. You know, we can see that the US is doing well. We continue to believe the risk assets will continue to perform fairly well over the next 12 months. So you want to have some exposure to both domestic, some to international.
And according to Ned Davis Research, foreign investors now allocate roughly 30% of their U.S. assets to equities. That's near record highs and well above the long-term average of around 19%. That suggests that global investors are holding firm in U.S. markets, not heading for the exits. I did have the chance to also speak with Truist Chief Market Strategist Keith Lerner about this. He told me it all comes down to earnings and tech dominance as well. International profits have lagged. Foreign markets simply don't have the same exposure to innovation, especially in artificial intelligence. And we've seen how much that's driven a lot of this U.S. growth. So even though there is a case for holding international equities as a defensive hedge, Wall Street's spring panic looks more like a blip rather than a lasting trend.
GLP-1 is in a transitional stage with new innovations in the works such as oral formulations of weight loss drugs. Eli Lilly and Novo Nordisk dominating the GLP-1 space, but Amgen making its move as the company says it has started two critical late-stage trials for its weight loss drug. For more on the weight loss market, let's get to Citi Research Managing Director Jeff Meacham. Jeff, it is great to see you. Maybe start big picture for us, Jeff. I'm curious what the Citi house view is of how big, Jeff, you think the GLP-1 market could eventually become. I see some estimates out there, Jeff, $100 billion annually within the next decade, but I'm curious to get your thoughts, how big you think the market could become eventually. What are the variables that depends on?
Yeah. Thanks for having me, first of all. Yeah, and great question. I think we can get to $100 billion. I mean, it could easily be by the end of the decade. So you don't even have to wait, really more than 5 years or so. The limiting step here is there's two things. One is how big could these drugs be outside the U.S. right now? A patient on one of the GLP-1s for obesity still has to have, for example, comorbidities. But Lilly's drug, which you mentioned, the oral drug, if that becomes a consumer-driven drug, then that could be a big deal with maybe more out-of-pocket costs. And then I think it's just expansion of the indications. So not just diabetes or obesity, but into cardiovascular disease, into maybe inflammation. These drugs do more than just cause weight loss. They cause, for example, lower blood pressure, lower lipids. So there's a totality of a benefit that I think the category, I feel like, has a lot of innovation and a lot of growth still left, for sure.
How well, Jeff, do these drugs work? I ask because you have so many headlines and reports and studies. It's tough to keep up. I mean, weight loss, but then you have concerns about muscle loss that are out there. What do we know?
So what we know is, between Novo and Eli Lilly, the drugs, the injectable drugs, and it's a simple once-a-week injection. It's with a pen, subcutaneous, very, very much painless. At the low end, it's something like 12 or 13%. At the upper end, it's 20%. And that's the data, and that's probably the real-world experience as well. It could be, it's not going to be much more than 20. The oral drugs are maybe slightly less potent, we'll call it 10 to 12%. But the key thing here is that these drugs are very well tolerated. That is, I think, one of the bigger, concerns for investors and really in patients is, nausea, vomiting, diarrhea, a lot of the GI side effects. Is that going to be kind of a deal breaker when you think about how long a patient could be on these drugs? As it turns out, in the real world, they're better. They're better than what we saw in clinical trials. Patients start off at a very low dose and kind of work their way up the titration curve to a higher dose, and then you can get to teens, mid to high teens weight loss without really much of an issue, I think.
And when do the pills officially hit the market, Jeff? Is that next year? And do we have any line of sight on pricing there?
Yeah, so officially, Lilly, if they take one path, it's a traditional path, accelerated approval. It'll put it on the market, maybe next summer. There is a path that the Trump administration has established with the FDA that could lead to, I say could because that's not the investor expectation, it could lead to a 1 to 2 month review cycle. So I don't know, I would call it maybe a 1 in 4, 1 in 3 chance that it could be available, the pill could be available this fall, November, December. That would be remarkable if you had that fast of review. But either way, though, I think most investors are thinking about next year, middle part of next year as being the first availability.
And I know, Jeff, I think you mentioned Lilly. I think you're buy rated on Lilly. What about Amgen, though? How do they stack up? How do they compare and contrast?
So if you think about Amgen in this context, my guess is at the end of the decade, it'll probably still remain a Lilly and a Novo, domination. I mean, it's probably 90% of the share will be those two companies. The remaining share, the jury's still out, but Amgen, I think, is given the prize of maybe the third company to the space because, as you mentioned, they're in a bunch of phase 3s. The differentiation of their drug, Maritide, is that it has, very competitive weight loss. The tolerability hasn't been as competitive, but it could have a longer acting, mechanism. So every 2 months or every 3 months type of injection, as opposed to a once a week. And I think that appeals, I think, to a lot of patients. And so, but we still have to see how that looks in phase 3. The phase 2, I think, are de-risking in that they, the drug works and was sufficient enough to go to a pivotal study. But whether that's going to be competitive with Novo and Lilly over time, we'll have to see.
Finally, Jeff, while I have you, we did have the president post on social media. He called these new levies on pharmaceuticals. How, if at all, Jeff, walk me through how you think that could impact your coverage universe.
Yeah, it's interesting. I mean, the pharma tariffs have been a big part of the conversation in big cap biotech and pharma really for this entire year. There's not a lot new to the conversation other than, I think it's just a public negotiation. That's kind of what Trump did last night. And it's what he's done all year is, trying to pry companies to make sure that they build manufacturing and all stages of manufacturing plants from the API to fill finish facilities in the U.S. And so bring jobs, bring manufacturing, skills here. So I think the tariffs, most companies have been fairly, I would say, less willing to make a bold call other than, yes, we're going to build manufacturing. And yes, we have some offsets to tariffs if that does play out. But I feel like, there's been a lot of anxiety that's been related to like the public negotiation, which is kind of President Trump's style. But I think it's still, it's still TBD whether, these are really going to play out in, this fall or next year. The companies have the margin, though, I think, to pay the tariffs. The question is, like, what's the end user rate going to be per company?
Jeff, great to have you on the show today. Enjoy the weekend.
Yep. Thank you. You too.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.